It really does feel like every time you turn around in this crypto world, the rules of the game have changed again. It's tough to keep up, right? You think you've got a grip on things and boom, something new comes along.
It really is constantly evolving, isn't it? But hey, that's what keeps things interesting, at least in my book.
True enough. That's why we do these deep dives, right? To help us make sense of it all. And for this one, wow, you guys have really outdone yourselves. This collection of material you sent in, it's a lot.
We've got a lot to unpack, that's for sure.
We're going to do our best to cut through all the noise and really distill what some of these recent shifts in regulation mean for, well, for all of us, really.
Absolutely. I mean, we've got updates on virtual asset laws all the way in the Cayman Islands, the latest from the UK's Financial Conduct Authority, the FCA, on what they're planning for the coming year, and then the EU's MiCA regulation that's finally a reality. Plus, we've got expert opinions on what all this means on a global scale.
Oh, and let's not forget the guidance from the Bank for International Settlements, the BIS, on how banks should be approaching crypto, how the U.S. SEC analyzes digital assets, and the European Central Bank, the ECB's, insights on stablecoins. Like you said, a lot.
But that's why you're here, right? To help us navigate this regulatory maze.
I'll do my best. Let's see if we can find our way through.
All right, so let's jump right in. What caught my eye right away was what's happening in the Cayman Islands. They're making some big changes for these virtual asset service providers, right? VASPs, I think they call them. Yeah, and what's particularly interesting is this move from simply registering as a VASP to needing a full-blown license for certain activities. So as of April 1st this year, 2025, if you're offering what they call a virtual asset custody service, essentially looking after and managing digital assets for other people, or if you're operating a virtual asset trading platform, which means you're running a place where people can exchange virtual assets for regular money, fiat currency, or even other virtual assets, and you're charging a fee for it, well, you're going to need a license to do that in the Cayman Islands now. It's definitely a sign of the time, stricter oversight, more hoops to jump through, moving away from that simpler registration model.
So for the companies who are already registered there, I mean, what happens to them if they're doing one of these things that now requires a license? What do they have to do?
Yeah, that's a great question. It's a real transition period for a lot of players. So if you are already registered and you're doing things like virtual asset custody or running a trading platform, you've got 90 days from April 1st to apply for this new license. Now, of course, that means a bunch of paperwork. You need to put together all the documentation listed in Schedule 1A of these 2025 regulations. But to their credit, the Cayman Islands Monetary Authority, they've created a VASP licensing transition checklist. I mean, it's a bit of a mouthful, but it's actually pretty helpful. It's designed to really guide these existing businesses through the process, make sure they have everything in order.
Yeah, I can imagine something like that checklist being a real lifesaver when you're trying to make sense of all this stuff. And look, if they've already given the authorities some of this paperwork in the past, do they have to go through the hassle of submitting everything all over again?
Well, not necessarily. If the documents they've already sent still fit the current licensing requirements and haven't been updated, they can just, point that out on the checklist. So that's a bit of a break. But of course, the checklist itself, along with any documents that have been updated, well, those have to be submitted as part of the application. They're not letting anyone off completely scot-free.
Okay, fair enough. What about those brand new businesses that are thinking, hey, maybe the Caymans is the place to be and want to set up shop there and offer these virtual asset services after April 1st? What's their process?
So for anyone new coming in, they'll need to use the authority's online platform, REEFs. They have to submit all those documents from Schedule 1A, plus a separate VASP licensing and waiver application checklist, and of course, the AML-CFT form. Now, AML-CFT, just as a reminder for those who might be new to all this, that stands for anti-money laundering and counter-terrorist financing. It's kind of a big deal in this world.
Right. And it's only getting bigger as the crypto world gets more intertwined with traditional finance. Yeah. You also mentioned waivers earlier. Who might be eligible for one of those?
Ah, yes, those waivers. So those are specifically for entities that are already supervised under some other kind of financial regulation in the Cayman Islands. Like, let's say you're already regulated as a bank or something, and you want to add these virtual asset services on top of what you already do. If those new services don't really change the fundamental nature of your activity, you can try for a waiver.
Interesting. So you're sort of saying, look, we're already under your watchful eye, so you can trust us to do this right.
Exactly, but you still need to go through the process. You need a formal legal opinion from an independent source that says, yeah, this waiver request makes sense. And you have to submit all that through RDEEFs, along with the relevant bits from that licensing and waiver application checklist. The authority is really big on people meeting with them before they apply for a waiver, just to talk things through. They seem pretty keen on open communication.
Makes sense, right? You don't want any surprises down the road. And actually, they're recommending that everyone, whether they're new or transitioning, have a chat with them, aren't they?
You got it. They want all applicants to schedule a meeting and to go through their regulatory policy registration or licensing of virtual asset service providers, and also the rule virtual asset custodians and virtual asset trading platforms, along with its statement of guidance. Basically, they're saying, do your homework, understand what you're getting into.
Sounds pretty reasonable to me. And, of course, we can't forget about the fees, right? There are always fees. What can applicants expect there?
Right. Well, you've got your basic application fees, whether you're going for registration or a full license. And then, of course, there are separate fees once your registration or license is actually approved. They're not giving this away for free, that's for sure.
Right.
All the details on the fees are in Schedule 2 of those 2025 regulations.
So, bottom line, what happens if you just say, forget it, and operate without any of the necessary permissions in the Caymans after April 1st? What's the risk?
Well, it's pretty straightforward. If you're doing those specific virtual asset services, custody or operating a trading platform, and you don't have the registration, the license, or a waiver, you're breaking the law, plain and simple. The VASP Act, to be precise. And that can mean penalties, enforcement actions from the authority. They could even shut you down entirely. So yeah, compliance is definitely the name of the game.
No messing around there. So we're seeing these individual jurisdictions like the Cayman Islands really tightening up. But then you've got organizations like the FATF, that's the Financial Action Task Force, right? Who are looking at the bigger picture, the global implications of all this.
Right. And FATF, they're really focused on updating their international standards and consulting on new guidance, specifically to promote financial inclusion. It's interesting, right? They've actually got this public consultation open right now, looking at potential changes to their anti-money laundering and counterterrorism financing measures. And they're also looking at their specific guidance on financial inclusion. You can actually submit comments until April 4th.
So they really want to hear what people think.
They do. It's all about finding that balance, making the global AML CFT framework more effective, but also making sure it doesn't accidentally shut people out of the financial system, especially those who are already underserved.
It's that classic tension between security and accessibility. Okay, let's shift gears a bit and head over to the UK. The Financial Conduct Authority, the FCA, has released their work program for the coming year, and it sounds like they've got crypto assets pretty high on their agenda.
Oh, yeah, they definitely do. They've actually called out crypto assets specifically as a key area of focus for 2025-26.
So what are some of the big things they're planning to tackle? What should we be watching out for?
Well, they've got a few key objectives that are going to have a real impact on the crypto space in the UK. First off, they want to digitize and improve their whole authorization process for financial firms. That could mean things get a lot more efficient and maybe faster for crypto businesses that are trying to get authorized to operate in the UK.
Okay, so potentially good news for those businesses, right? Less bureaucracy.
Possibly, yeah. They're also looking at improving their supervision model. The plan is to focus their engagement on the areas where they see the biggest risk of harm, either to consumers or to the financial system as a whole. And they want to be more open about those risks and also the opportunities they see in the market.
So kind of setting out their stall a bit more clearly.
Exactly. That way, crypto firms will have a better understanding of what the FCA is really worried about, what their priorities are. Oh, and they're also planning to get a lot smarter with data. They're going to be using more intelligence and data analysis to spot potential problems in the financial sector. And that definitely includes crypto.
It sounds like they're really taking the whole data-driven approach to heart.
Yeah, and they also seem really keen on promoting innovation, which can be tricky in the crypto world, right? You need to balance that with regulation.
Absolutely. You don't want to stifle creativity, but you also don't want to let things run wild. What's their approach there?
They've said they want to accelerate digital innovation, which is encouraging. And part of that is working with firms on adopting artificial intelligence, AI. They've even got a dedicated AI lab to help with that. They're also going to be looking at whether GDPR, the EU's big data privacy law, the one that still applies in the UK, even after Brexit, is creating any unintended roadblocks for AI innovation in finance. And get this, they specifically mentioned that they want to extend their pre-application support service, the PASS, to crypto firms. It's designed to help new firms navigate the whole process of setting up and growing in the UK.
So it's not just about cracking down. They're actually trying to support innovation in a responsible way.
That's the idea, at least. And they've got some specific projects in the works related to digital assets, too.
Oh, yeah. Tell me more.
Well, they're still running that digital securities sandbox, the controlled environment where firms can test out new digital asset products and services. And they're working on a broader roadmap for digital assets, a longer-term plan. They're starting with the asset management industry, which suggests they're really serious about regulated digital asset products going mainstream.
Interesting. So moving beyond the niche and into the everyday world.
That seems to be the direction of travel.
We also can't avoid talking about financial crime, right? That's always a big concern in the crypto world. What's the FCA's plan there?
Well, combating financial crime is still right at the top of their list. They're planning to build new data-driven systems to detect illicit activity, and they're going to be working more closely with law enforcement to tackle organized crime. They're also investing in their own internal systems and technology, and they'll be collaborating with partners both in the UK and internationally. Plus, they're going to be keeping a close eye on the anti-money laundering systems that all financial firms have in place, including those dealing with crypto.
So the message is clear. If you're in the crypto space in the UK, expect to be under the microscope.
Pretty much.
And of course, all of this requires money, right? The FCA has to have a budget to do all this work. Anything noteworthy about their financial plans?
Well, their proposed budget for 2025-26 is a cool £783.5 million. And within that, they've specifically earmarked £7.8 million for work that's directly related to crypto asset stablecoins and the whole crypto regulatory regime.
So they're putting their money where their mouth is, so to speak.
You could say that. They're also sending back £1 million that was previously set aside for work on crypto asset financial promotions but wasn't actually used. Kind of shows how quickly things are changing, even their own internal priorities. But overall, yeah, they're clearly putting some serious resources behind getting a handle on the crypto market.
Okay, so we've looked at the Cayman Islands, we've looked at the UK. What about the bigger picture? What are the experts saying about the overall direction of crypto regulation globally? It seems like there's a growing sense that regulation is really becoming the defining force in the industry.
Yeah, that's a pretty common theme. John Salmon, for instance, he straight up says that regulation is the single biggest thing happening in the crypto space right now. And he specifically points to the EU's MiCA regulation as a prime example of how things are changing. He thinks MiCA is going to bring some much-needed clarity to the market and actually encourage more mainstream investment.
So regulation as a catalyst for growth rather than a barrier.
That's his argument, yeah. But Javier Alvarez, he points out that there are still some big challenges ahead. One of the main ones is actually just defining what different types of crypto assets are. I mean, it sounds basic, but it's not always easy to pin down. He also says that regulators are having a tough time keeping up with the pace of innovation in areas like decentralized finance or DeFi and non-fungible tokens, NFTs. And then, of course, there's the whole issue of consumer protection, making sure people aren't getting ripped off.
Right, because that whole move fast and break things ethos of the early days of crypto, that doesn't really fly when you're talking about people's hard-earned money.
Exactly. It's a different ballgame now. And then John Ahern, he talks about this balancing act that regulators have to perform. They want to encourage innovation, but they also need to make sure the whole financial system doesn't go up in smoke.
Right. It's a tightrope walk. You want to let the good stuff flourish, but you also need to put up some guardrails. What else does Ahern highlight?
He talks about the legal uncertainty around digital assets. I mean, what is a digital asset, legally speaking? The answer can actually change quite a lot depending on where you are in the world, which obviously creates headaches for global businesses. And then there's this thing called regulatory arbitrage. That's where companies try to set up shop in places with looser rules to avoid stricter ones elsewhere. That's a big problem for regulators who are trying to create a level playing field. Charles Kerrigan, he focuses specifically on the U.S. He describes the U.S. regulatory approach as kind of uncertain. Right now, it's a bit of a tug of war between those who want to let the market grow freely and those who are more worried about potential risks to investors and the financial system as a whole. He thinks things are going to keep evolving in the U.S. It's definitely a space to watch.
Okay, so the U.S. is still figuring things out.
That's a fair assessment, I think.
We've talked about rules, but what about actually making sure those rules are followed? What are the experts saying about enforcement?
Well, one interesting point that Ahern makes is that because a lot of these crypto regulations are relatively new, enforcement tends to be strongest in areas where you can apply older, more established rules. Like, think about things like anti-money laundering laws. Those have been around for a while, and regulators are pretty comfortable using them in the crypto context. Ahern actually mentions the FCO's first enforcement action related to crypto asset trading that happened back in July 2024.
So they're using the tools they already have.
Exactly. And then, of course, you've got the U.S. Securities and Exchange Commission, the SEC. They've been pretty active in taking enforcement actions, particularly around classifying certain cryptocurrencies as securities under U.S. law. But, crypto is global, right? So all the experts agree that international coordination is key if you really want to stop the bad actors. Because if one country cracks down, those bad actors will just move somewhere else if they can.
It's like a game of whack-a-mole.
Kind of, yeah.
All right, let's shift gears a bit and think about the companies that are actually operating in this space, trying to make sense of all these rules. What kind of advice are the experts giving them? What kind of internal processes and risk management strategies should they be putting in place?
Charles Kerrigan is very clear on this. Security has to be the #1 priority. Everything else flows from that. And Javier Alvarez, he really emphasizes the need for a comprehensive compliance framework. He's not just talking about meeting traditional financial regulations, but also making sure you're on top of all the specific requirements for digital assets, things like KYC, AML, sanctions compliance, and transaction monitoring. He also says that regular risk assessments are crucial, and you need strong internal controls to protect yourself from fraud and data breaches. Oh, and staying informed about all the latest regulatory changes, that's a big one. And of course, making sure your staff are properly trained on all of this.
It's like drinking from a fire hose, right? There's just so much information to keep up with. What else did the experts recommend?
Alvarez is a big advocate for working with legal and compliance professionals who really understand digital assets. And he says that using technology can help a lot. Things like blockchain analytics tools and case management systems. He also mentions whistleblower policies. That's something companies really shouldn't overlook. John Salmon, he adds that companies shouldn't wait for regulations to come knocking on their door. They should start putting these controls in place now, even if they're not strictly required yet, especially when it comes to protecting retail investors' money and meeting AML and CTF standards.
So be proactive. Don't wait for the regulators to catch up.
Exactly. He also has a word of caution about benchmarking yourself against other crypto companies. Just because everyone else is doing something a certain way, it doesn't mean it's the right way or that it's going to meet future regulatory expectations. He says companies should really be looking at established international standards and best practices from the traditional financial world. That's the gold standard.
Interesting. So don't follow the crowd. Aim for the best of the best. Okay, there was a really interesting news story recently about the U.S. Justice Department and how they might be changing their approach to crypto enforcement. What's the latest on that?
Yeah, this is still developing, but there are reports that the Justice Department is thinking about dismantling its dedicated crypto enforcement unit. Now, this unit was involved in some pretty big investigations, like the one into Binance.
Binance, that's the giant crypto exchange, right?
That's the one. And it seems like they're shifting their focus away from specifically targeting virtual currency exchanges, those mixing services that try to make transactions untraceable, and offline crypto wallets. They specifically mention Tornado Cash, which is one of those mixing services that has been in the spotlight before. So it's looking like the Justice Department might be taking a different tack, which could have big implications for how crypto is enforced in the U.S.
Yeah, definitely a story to follow. All right, let's move on to the EU now. MiCA, the markets in crypto assets regulation. It's finally here, fully in effect. This is a huge deal for the crypto world in Europe, isn't it?
Massive. I mean, MiCA is a big, ambitious attempt to get a grip on all the different risks that come with crypto assets, but also to encourage innovation in the sector and to create a more secure and transparent ecosystem for crypto across the whole EU. And its main provisions actually kicked in back in December 2024. So yeah, it's a big deal.
Okay, so break it down for us. What does MiCA actually regulate? What does it cover?
It covers a lot of ground. It regulates things like providing custody services for crypto, running those platforms where people can trade crypto assets, exchanging crypto for regular currencies or other crypto assets, executing orders for clients, placing crypto assets with investors, providing advice on crypto, even managing crypto portfolios. It's pretty comprehensive.
Stablecoins have been a particular focus for regulators around the world. How does MiCA address those specifically?
MiCA has pretty strict requirements for entities that are issuing those e-money tokens, EMTs, and asset reference tokens, IRTs. Basically, if you want to offer these tokens to the public or have them traded on exchanges in the EU, you need to be authorized under MiCA. For arts, the issuer usually has to be legally set up within the EU and authorized under MiCA, or in some cases, they could be an existing credit institution. And for EMTs, the issuer usually needs to be a credit institution or an e-money institution, although there are some exceptions.
Sounds complicated.
It is a bit. But the main goal is to make sure that these stablecoins have enough liquid assets backing them up, that people can redeem them without any problems, and that there are strong safeguards in place to prevent those liquidity crises that can happen with stablecoins, where people suddenly lose confidence and rush to cash out. It's about keeping things stable.
Right, because those kinds of events can really ripple through the whole crypto market, can't they?
Absolutely. And they can even have knock-on effects in the traditional financial system. It's all interconnected.
And MiCA also tackles market manipulation and insider trading, right?
Yeah, it has a whole new set of rules on market abuse. It covers things like unlawfully disclosing inside information about crypto assets, insider dealing based on that information, and anything that looks like market manipulation. It's all about making sure trading is fair and transparent and protecting investors.
Makes sense. With such a big, complex piece of legislation, I imagine there are quite a few different regulatory bodies involved in making it all work, right?
Oh, yeah. There's a whole cast of characters. At the EU level, the European Securities and Markets Authority, ESMA, they're the ones who are responsible for making sure that crypto regulations are applied consistently across all different EU member states. They develop technical standards, issue guidance on how to interpret MiCA, and they keep a public register of all the authorized crypto asset service providers, or NASPs, and also the issuers of RTs and EMTs.
So they're kind of like the conductors of the orchestra, making sure everyone's playing in tune.
That's a good analogy. And in certain cases, they can even have direct supervisory powers, especially if a CISP is seen as high risk or operates in multiple EU countries. They're taking a risk-based approach to authorization, though. They're very clear that no CISP should automatically be considered low risk. Then you've got the European Banking Authority, the EBA. They're more focused on the issuers of stablecoins, both ARTs and EMTs.
And why is that?
Well, it's because stablecoins are often used for payments, and they can be linked to traditional assets. So there's more potential for them to impact the stability of the financial system as a whole.
Right, and they want to avoid another situation, like we saw with Terra USD, where a stablecoin collapses and creates a domino effect.
Exactly. The EBA works closely with the national regulators in each EU country to look at how stablecoin issuers are governed, how they manage their reserves, and how resilient they are operationally. And for those really big, systemically important issuers, the EBA can step in with enhanced supervision, things like more frequent reporting and stress tests. They can even recommend corrective actions or even suspend or revoke an issuer's license if they're not playing by the rules or posing a risk to financial stability.
So they've got some real teeth.
They do. They need to keep things in check. And then there's the European Central Bank, the ECB.
What role do they play?
They're not directly involved in supervising crypto firms, but they do have a say, especially when it comes to stablecoins, that could affect the EU's monetary policy or the stability of the euro. MiCA actually requires the EBA and those national regulators to consult with the ECB when they're assessing those big, systemically important stablecoin issuers. So the ECB can definitely influence things if they think a stablecoin is going to mess with existing payment systems or compete with a potential future digital euro.
Right, they're looking out for the big picture, the macroeconomic implications. We're talking about the EU, so we can't forget about data protection, right? How does MiCA fit in with GDPR, the EU's big data privacy law?
It's important to remember that whenever you're dealing with personal data under MiCA, you still have to follow all the rules of GDPR. That's just the baseline in the EU. The European Data Protection Board, the EDPB, they're the ones who watch over GDPR, so any handling of personal data in the crypto world has to be done right, according to those privacy rules. It's not specifically part of MiCA itself, but it's part of the bigger regulatory picture. And then, of course, you've got the financial intelligence units, FIUs, in each EU country. They'll be busy monitoring crypto transactions and trying to stop money laundering and terrorist financing.
So a lot of different players all working together, or at least trying to. MiCA also has these categories of crypto assets, right? Can you walk us through those and explain why they matter?
Sure. You've got asset reference tokens, or RTs. They're the ones that try to stay stable by pegging their value to some other asset, like a regular currency or a commodity. Then you've got e-money tokens. EMTs, those basically represent electronic money, fiat currency, but on a blockchain. Utility tokens are for crypto assets that give you access to specific goods, services, or features offered by the issuer. And finally, there's a big catch-all category called other crypto assets. That's where things like Bitcoin and Ethereum end up, but also governance tokens and those weird hybrid crypto assets that don't really fit anywhere else.
Okay, so why do these categories matter? Is it just about keeping things tidy?
It's more than just tidiness. The specific rules that apply under MiCA depend on which category a crypto asset falls into. So the rules for stablecoins, those RTs and EMTs, they're way stricter than the rules for other crypto assets. It's all about managing risk appropriately.
Makes sense. One of the things that really stands out about MiCA is this requirement for crypto asset white papers. What are those all about, and what needs to be in them?
The white paper is a really important document. It's like a detailed prospectus for the crypto asset. It has to include all sorts of information about the issuer, a description of the project and the technology behind it, the rights and obligations attached to the crypto asset, and this is crucial, a really clear explanation of all the risks involved in investing in or using that crypto asset.
So no hiding the downsides.
Nope, full transparency is the key here. And these white papers have to be submitted to the national regulator in the issuer's home EU country, and then they get passed on to ESMA, who puts them in a public register. Everyone can see them.
Sounds like there's no escaping the scrutiny. And I'm guessing MiCA is pretty strict about how these crypto assets are marketed too.
Absolutely. No misleading marketing allowed. Everything has to be accurate, clear, and consistent with what's in the white paper. Regulators can even shut down marketing campaigns that aren't playing by the rules. It's all about protecting investors from hype and false promises.
Right, no more of those get-rich-quick schemes that were so common in the early days. Beyond the disclosure stuff, what about the nuts and bolts of how these companies operate? What kind of operational safeguards does MiCA require?
MiCA is pretty demanding in this area. It requires issuers and those CASPs, the crypto asset service providers, to have really robust operational safeguards in place. This covers how they manage their own funds, the security of their technology, their AML processes, the whole 9 yards. And one big thing is that they have to keep client funds and crypto assets completely separate from their own assets.
So no commingling of funds.
Nope. That's a big no-no. It's all about protecting investors if the issuer or the service provider goes belly up. And issuers can't just say, oh, we're not responsible for what's in our white paper. They're liable for the information they put out there.
So no more hiding behind fine print.
Not under MiCA.
What kind of impact do you think MiCA is going to have on the crypto industry in the EU and maybe even beyond?
It's already having an impact, even though it's only been fully in effect for a few months. It's likely to lead to some consolidation in the market. Those smaller players that can't afford to meet all of the new requirements might struggle, while the bigger, well-resourced companies will probably do just fine. Overall, I think it's going to increase trust in the crypto space. People will feel more confident knowing that there are clear rules and that consumer protection is a priority. And that's going to benefit those compliant stablecoins and those regulated CASPs. They're going to be the winners in the long run.
So MiCA is kind of separating the wheat from the chaff, so to speak.
That's one way to put it.
For companies that are operating in the EU, we're thinking about going there. What are the big things they need to be thinking about right now when it comes to MiCA compliance?
Well, the first thing is obviously making sure they have the right licenses and authorizations to operate as a CASP if they're offering those regulated services. And if they're planning to issue crypto assets to the public, they need to get those white papers done right. That's absolutely essential. They also need to make sure all their marketing materials are squeaky clean and don't contradict anything in the white paper. Strong governance, cybersecurity, clear procedures for segregating client funds, all of that is crucial. And they need to make sure their staff are fully trained on MiCA. Oh, and those RegTech solutions, the regulatory technology stuff that can really help them streamline their compliance processes.
Sounds like a lot of work.
It is, but it's the price of doing business in a regulated environment.
And what happens if they don't comply? What are the penalties like?
Let's just say you don't want to mess with the EU regulators. Non-compliance can mean some pretty hefty fines. We're talking millions of euros or even a percentage of a company's total turnover. And the worst case scenario is having your operating license revoked. That means you're basically shut out of the entire EU market.
So, game over.
Pretty much. And then there's the reputational damage. Regulators can publicly name and shame companies that break the rules, which can be a real killer. And in some cases, non-compliance can even lead to criminal charges. They can suspend your activities, freeze your assets, ban you from offering certain products or services, the list goes on. They can even hold individual executives personally responsible. Remember what happened with Binance in some EU countries? That's a cautionary tale right there.
Not a good example to follow.
Yeah.
MiCA is in place now, but are there any other changes or updates in the pipeline that companies need to be aware of?
Yeah, one big one is the integration of the transfer of funds regulation, the travel rule, into MiCA. That's supposed to happen fully in 2025. Basically, CASPs will have to include information about the originators and beneficiaries of all crypto asset transfers they handle, where the money is coming from and where it's going. It's all about making transactions more traceable, making it harder for criminals to launder money.
More transparency, more accountability.
Exactly. And we're already seeing MiCA having an effect on stablecoins. Some of the ones that don't meet the new requirements are being delisted from exchanges in the EU. It's going to be interesting to see how all of this plays out.